Welcome back. Shares of Best Buy down by 8.5%, as you can see in early trading in New York today. That's because the retailer reduced its full-year same-store sales forecast and missed Wall Street's quarterly revenue expectations. Let's get more from Seth Basham. He's an analyst at WedBush and covers the stock. Seth, thanks a lot for joining us. I think you expected an underwhelming quarter when you previewed these results a few days ago. Give us your thoughts on what Best Buy has actually reported.
Sure. Thanks for having me. The company's comparable store sales were down 2.9% for the quarter. This compares to the guidance and our consensus forecast of down 1%. Margins held up pretty well to support profitability, so they only missed slightly on EPS, but they're grappling with the volatile demand environment and a soft demand environment overall. Consumers are shopping more for value, they're shopping around events, and there's weakness leading up to the presidential election. Now, there are some silver linings here. We did see an improvement in comparable store sales trends to start the fiscal fourth quarter here in the first 3 weeks of November. So that's good, but it's unclear whether or not that'll sustain.
A lot of people in this country are talking about Donald Trump and his latest tariff promise. You have said in some recent research on this company that within your coverage, Best Buy has the most exposure to increased tariffs because it gets so many of its products from China. So that's not good exposure to tariffs. Why don't we flesh out that topic?
Yeah, that's right. Over 90% of what they sell is imported. 60% of it's from China. We estimate another 20 to 30% is from Mexico, particularly in TVs. So they have a fair amount of exposure there. We've seen this company navigate tariffs in the past with some detrimental effects to their profit and loss statement. Revenues have been pressured in 2019. Margins have been pressured as they've had to absorb some of those higher costs themselves. So there are some mitigation strategies, but we think that there will be negative effects on them if these tariffs do, in fact, go into effect.
Wouldn't the tariffs affect all U.S.-based retailers of electronics in a similar way?
No doubt it'll affect everybody, but there could also be some demand destruction as consumers have more limited discretionary spending power, having to deal with the higher levels of prices driving inflation.
One thing you're watching is a product refresh cycle in the electronics area, including more products with artificial intelligence applications. How soon is that coming, and how much of a positive could it be for Best Buy?
It's a very slow build at this point. I think we'll see more indications of it in the fourth quarter and more in 2025. But right now, the applications in consumer electronics are pretty limited. There are some laptops that have AI features. The new Apple iPhones have just gotten AI features released, but those aren't major sales drivers right now. The bigger drivers for the company are really around replacement demand, especially in laptops. Many people bought laptops during the pandemic, and now a couple of years later, they have to replace those. So they're seeing 7% comps in that category, which is quite strong, but AI-related sales are still on the come.
This company has been in a turnaround mode for a while. Even with today's dramatic come down in the share price, the stock is still up about 10% so far this morning. So as of yesterday, the stock was up 17, 18% on the year. So the market seems to have recognized management's ability to execute in a difficult market. We were looking at the one-year history of the price. It looks like the stock has jumped up on a couple of earnings release days in June and perhaps September. How well is the company executing on the turnaround strategy?
Yeah, they're controlling costs, which is great. Their gross margins are pretty strong as well, especially as they've gotten benefits from changes to their loyalty program. They've been doing a better job attaching warranties to sales. But those don't outrun what's happening on the demand side. When you have negative comparable store sales, it's really difficult to grow profitability. So we need to see continued improvement in demand, continued product cycle acceleration for me and many investors get comfortable owning the stock in 2025.
You've got a neutral rating on the stock and a price target of 95. Two questions. Will you revisit that price target in light of today's news? And secondly, what would it take what do you need to see to move back to a buy rating?
Sure. Our earnings and price targets are always under review. As it relates to our potential change, it will really depend on that top line. We need more visibility to accelerating top line and turning to positive comps in 2025. We have some early indications of that within laptops, but we need more categories to follow that lead. So right now, we remain neutral.